bias, risk, targets, and why. If you regularly read my posts or listen to my videos, I try to be as consistent as possible. I use the same technical tools. I admit other tools for a reason. I focus on specific time periods. That is by design and something I encourage all traders to do. The reason is, to be successful as a trader, you need to be consistent. If you are not consistent with what you are looking at and how you are interpreting what you see, you simply increase uncertainty. You lose confidence, which increases fear. And once that happens, you might as well write a check to the broker for your entire account balance and mail it to them. It is as simple as that. So whatever you do, be consistent. Now, being consistent to me means using tools that others use. I want to understand where the market, that is the collection of traders from around the world, are gathering. Think of them as a group of people that gather on a street corner. That group will all move away from that street corner at some point. They will go either this way or they will go that way. That is what technical tools do for me and should do for you too if you believe. I show you each day on my post why you should believe. I also use tools that define a bias, that define a risk, and define targets. Those three explain the why in my trading. So what is the bias? The bias is either bullish or bearish. Generally speaking, if the price is above a technical level or levels defined by a tool or tools, the bias is bullish. Conversely, if the price is below a technical level or levels defined by a tool or tools, the bias is bearish. Now, there are degrees of bullish and bearish biases. There can even be a bullish bias and a bearish bias at the same time. Think of a bullish bias as the market trends to the upside in a longer-term chart, while there is a shorter-term bias to the downside as that trend looks to correct 100, 200, or maybe even 300 pips. Shorter-term corrected biases are trading opportunities too. A shorter-term bias may turn into something bigger as well. All major tops and bottoms started at some point where there was a conflict with a longer-term bias and a shorter-term bias. The point is, with a bias, your trade/view should be supported by a bullish or bearish technical reason. Know the bullish or bearish reasons from the technical tools. Now, what about risk? Risk is the most important thing all traders should know about when they enter their trade. I like to say that if you don't know your risk is by default unlimited. If you don't know where you're wrong, that's wrong. You need to know where to get out. Risk, like the bias, are determined by the technical tools used. In my posts, I will often say, this level is close risk. I may also say, this is a more conservative risk. My risk levels are where I see the bias shifting to the other way of the trade. They are defined by the tools that I use. Now, traders need to define and limit their risk. The define part is where the bias, bullish or bearish, shifts from bullish to bearish or bearish to bullish. That is where you are wrong. Get out. Now, give yourself some room at those levels, but get out if the price action is not doing what you expect it to do. The limit part of risk, it allows you to risk a little to make more than a little. Now, why do I say that? I'm going to show you. I just did it. If you risk a little, you have an easier shot of making more than a little. The less you risk, it is easier for you to make a multiple of what you risk. Isn't that the goal of trading? You want to limit your losses and make profits to be a multiple of those losses. That means you can be right 40% of the time or maybe 30% of the time, and you will still make money. Since you are trading with the crowd at the technical levels, you are betting that the crowd will continue in the direction the bias says it should go. where the crowd walks that way or the crowd walks the other way. We have bias, we have risk. Now what about the targets? Targets are where you are going. You need to get to and through the targets to increase the bias in your favor. Targets are also defined by the tools of my trading. In my posts and videos, I will show the targets, the technical levels, and the direction of the trade. Think of the targets as the Google map for your trading journey. In the town I live in, I just got on the 101 off of Shea Boulevard, and I envision going to Target, the store, on Frank Lloyd Wright Boulevard. I am looking at the road and at my GPS at the same time. I'm being careful. There are other exits or targets ahead of my Target exit. There is Cactus Boulevard exit, which is mostly residential. Okay, I got past that exit. Most of the traffic did the same thing. There wasn't a lot of traders getting off of that exit, or drivers. So I'm good with my journey. The next exit is Raintree, where Kohl's and Costco are located. Now that is a tougher target to get to and through. But again, most of the traffic gets through the exit. Drivers are not going to Costco off that exit today. The traffic is pushing me to my final destination. The next target is Frank Lloyd Wright Boulevard, where I anticipate the crowds to get off to go to all the great shopping places there. In addition to Target, my target, there is Best Buy and there is Walmart. There are other places to eat as well, including McDonald's and Jersey Mike's and Twin Peaks and Oregano's. I get off with the crowd. My journey is complete. Targets in your trade are the exits on your journey. You need to know the Google Maps roadmap of where you are going to measure the progress of the crowds, of the drivers. As long as the traffic is getting through Cactus and Raintree and did not get off or turn around, Frank Lloyd Wright Boulevard is the next stop, the end of the journey or trade, the last target. Now, targets can be passed and then reversed and go the other way. You may get past Cactus and Raintree, but shortly after passing Raintree, suddenly the car turns around and goes back through Raintree. That is the time you stop your car and end the journey. Or maybe you wait until you get through Cactus to stop the car. You need to know the targets of where you are going to measure your progress, or to measure where the journey turns around and goes the other way. The final thing I do in my posts is explain the why. The why in technical trading is defined by the tools that define the bias, the tools that define the risk, the tools that define the targets. Those tools define the why in your trade as well. They give you the purpose. Why did I go long? Well, because the crowds gathered at the 100-hour moving average and then started to walk through the 100-hour moving average. Why did you get out of the trade? Because the crowd turned around in the middle of the crosswalk and went the other way. The price moved back through the 100-hour moving average. It didn't do what I expected it to do. Why did you stay in the trade? Because we got to the curb, that target, and continued to the next street/target with the crowd. In trading terms, we moved through the 38.2% retracement. Why did you exit the trade? Because the crowd exited to go to the concert at the arena. In trading terms, the 200-hour moving average and the 50% retracement stalled the market. So when you read my posts, when you watch my videos, I hope you start to hear more clearly the bias, the risks, the targets, and the why. They all come together to better understand your journey as a trader. So with that said and understood, I hope I will now go through the major currency pairs versus the US dollar from a technical perspective as you prepare for the next coming week. And I'll talk about the bias, I will talk about the risks, I will talk about the targets, and through them, explain the why. All right, now that we look through the ideas of bias, risk, and targets, let's take a look at the major currency pairs and plan our trade, understand where we stand, what the bias is, risks are, so on and so forth for the currency pairs. And I'm going to start with the euro versus US dollar and remind everybody of this risk defining level way back here in June to October of 2002. We had a number of swing lows here on the weekly chart that came between the 0.9662 and 0.9708. Remember those levels? Well, I'm going to show you those levels as well as other charts, but that area is going to be key going forward in the new trading week. Now let's take a look at the daily chart next. And what we see off the daily chart is that in trading this week on Monday, Tuesday, and Wednesday, on Thursday's trade, we fell below that level. This is the CPI data, and the bias turned more to the downside, but then we retraced and started to move back higher. And note here on Friday's trade, what was our low price? It came in at 0.9708 at the high end of that level off of the weekly chart. So it seems like buyers were leaning against that level, trying to keep the bias more to the upside. This area is going to be a key bias defining level in the new trading week. As long as the price can remain above it, I'm going to give the benefit of the doubt to the corrective move in the short term to the upside. There's work to be done, but I'll give the benefit of the doubt. If we move below this area, start to go below 97.08, start to go to 96.62, then the bias shifts more to the downside, starting here and then increasing through there. So that's important in our trading decisions going forward. Now, take a look at the hourly chart, and what do we see from here? Well, if we look at the hourly chart, Friday was a day where the market tried to the upside, tried to the upside, tried to the upside, and tried to the downside here. When I say tried, it tried to get above the 200-hour moving average, 200-hour moving average, 200-hour moving average, 200-hour moving average, and then it tried to get below the 100, 100, 100, 100. Couldn't do it with any sort of success. It's a Friday. We saw lots of choppy action in between those levels. We're going to be using these moving averages as our barometers, as our risk-defining levels, as our bias-defining levels in the new trading week. If the price trades to the downside here and gets below the 97.08 level and then the 96.62 level, that's going to increase our bias to the downside. Below that, we're going to be looking at this area right through here. This area, we had a swing high here, a swing low here, and the low price for the trading week this week came right down to that level, and we found the bid to the upside. So on the downside, our targets would be to get below this level, start to move below the 97.08 level, 96.62 level, and then our target down here. Those are our targets on the downside on a more bearish move below the 100-hour moving average. On the top side, what are we looking at? Well, we need to get first above the 100, get above the 100 and stay above that level. Then we'd be starting to target the 200-hour moving average. That's the level right here. And then we're going to start to look toward this swing area through here. And this swing area, actually, it sort of goes all the way back to here, doesn't it? Where we had swing lows, move to the downside, trade above and below it here, but then reestablish the area as a support level here and a resistance level here. In trading this week, what did we do? We found sellers against that area right through here. So if we are going to, on targets to the upside, need to get above the 200-hour moving average and then get above this 50% retracement and this swing area to increase the bullish bias for the euro versus US dollar. All right, so that's the look at that currency pair. Let's take a look at the dollar versus yen. And what we know about the dollar versus yen is it's trending. It's continuing to trend to the upside. We closed near the highs for the week. We're also closing near the highest levels going back to 1990. So the bias remains to the upside. What would hurt the bullish bias in the dollar versus yen? And if I take a look at the price action on Thursday, we did see a sharp move to the downside that came back down and tested this old trend line, this channel trend line. Admittedly, we fell below it here, but then we started to reestablish support against the level through here and moved higher. And again, on Thursday's trade, through the volatility of the CPI and all that stuff that went on, the price came right down to that level and found support. So this is the last trend move to the upside. If we take a look at the 38.2 to 50% retracement of that move to the upside off of the high, comes right through here. And also in this area is is this trend line, the top side of this channel trend line. So this area right through here, where we have the trend line, the 38.2, the 50% retracement, that's going to be our close risk defining level. As long as the price can stay above that level, the bias for this pair remains to the upside. We may see something like this where we come down. Oops, start that over. Where we start to move to the downside and then rotate back to the upside. Like this. As long as this price can hold, that would be more bullish. If the price were to go below that level, however, and start to trade back below the trend line into this channel, then the bias goes to the downside, and we'll start to look toward the lower end of the channel trend line, and then look toward the 100-hour moving average, which is moving to the upside here. So those would be our targets on the downside. Until then, the bias remains to the upside for the dollar versus yen. The bulls are in control. Where might we go? Where might be a target? There's not a lot of targets when you're dealing with the price at the lowest level since 1990, but if I look at the daily chart here and I look at the old trend line through here, this topside trend line around the 150.18 level would be a key target. Also, the natural 150 level would obviously be a key level to get to and through if the buyers are to take more control. Bias remains to the upside for the dollar versus yen. Let's take a look at the sterling versus US dollar. And again, I'm going to focus a little bit on the hourly chart here. Why? Because we saw the price bounce off of, at the lows this week, bounce off of this level right here. What's the significance of this level? Well, if we go back to these levels through here, and we also put a Fibonacci retracement of the move up from this low to this high through here, the 50% retracement and this swing area of this level, of this area, found support against that level, and that helped to give the pair the bounce and move to the upside in trading this week. Now, we did come into some resistance area through here. We have a swing area, swing lows through here, swing highs through here. Admittedly traded above and below it here and above and below it here, and we did move a little bit above it in the volatility from the Thursday's trade. But in trading on Friday, what do? We found sellers against this level. So on the top side, this area is going to be a key resistance level on the top side, so a target level on the upside. So we have support down here, resistance up here. That's the wide. Now, in between those two extremes sits the 100 and 200-hour moving average, and this is going to be the bias defining area for traders this week. If the price can move above the 200-hour moving average with momentum, we're going to start to look toward that level. If we start to move below this level, we're going to be starting to look toward the 50% retracement on our lower extreme through here. So this is going to be our key bias defining level. We right now are in a neutral area, neither bullish nor bearish B for this pair in this short term, but we're trying to figure out which way the market wants to go. Given all the political situation in the UK, I'm not surprised we're here. The market is waiting for the next shove, the next news item to get it out of its way, to get it either moving in this direction or moving further in the upward direction here for that currency pair. All right, let's take a look at the dollar versus Swiss franc. And if we take a look at this currency pair, what do we notice? Well, we notice that the price action this week moved above these swing highs right here and on Thursday, but we couldn't sustain momentum. The high area came in at par 63. The high price went to par 73. And in trading on Friday, we were closing the week right in between those swing areas between par 49 and par 63. Guess what? That's going to be our bias defining level. If we're able to move above that level, then the bias would be more to the upside here, and we'd be looking for just go, baby, all right? Just stay above this area, and the buyers remain in control. Conversely, if we start to move back below that level, we're going to look down toward probably this swing area through here, where we have where we had the lower highs through here, and we found some support buyers near on Thursday and Friday near that level. So this area right here around the 99.66 level would be where we have to get to and through on the downside to increase the bearish bias on the hourly chart. If we're able to get below this level, then we'll start to look toward this swing area through here, which had different swing highs and lows through here. So the daily chart is kind of showing a lot of the where the risk levels are, where the target levels are, starting with the this area right through here where we had the swing highs and where the market is closing on Friday's trade. Let's just take a look at the hourly chart for other clues here. And off the hourly chart, what we notice here and of significance is that the price tried to move below the 100-hour moving average. A lot of different attempts to get below that level. This one was the most recent on Friday, and really the one that broke the most below the 100-hour moving average. However, notice here where the price stalled on the downside, right near these old swing highs. So, and this really this swing low through here. So is this level going to be important on the downside? Yes. Is the 100-hour moving average going to be important? Yes. We need to get below both those levels in order to increase the bearish bias to the downside, including the 200-hour moving average, and we start to look lower here. So those are the levels on the downside. Again, if we are able to get below the levels on the daily, if we start to move to the downside here on the daily chart in the dollar versus Swiss. Okay, does it make sense? It does to me. Let's take a look at some of our commodity currency pairs. We'll take a look at the dollar versus Canada. This is trading at the highest level since 2020, and of note here on this pair is this area right here. These were the swing lows in the COVID period. This was the extreme area. Price moved above that level, came down to this level not once but twice, but 3 times here. And so around the 138.52 level is going to be our key barometer in the short term, and it comes on the daily chart. If we stay above that level, it's more bullish. We're looking for more upside. If we move below that level, I wouldn't be surprised if we start to move down toward this level right here, the 61.8% retracement, and also a old swing level right here, near swing highs right here. So at the 136.50 level. So watch the 138.52 level for short-term clues in the new trading week. Let's go to the hourly chart and see what that is telling us. And if we look at the hourly chart here, here's our 54 level, our 52-ish type level from the weekly chart. I'm going to bring it out here, and you can see how this area right here is going to be a key barometer. If we go below that level, then we're going to be looking toward the 100-hour moving average, and then the 200-hour moving average. These levels through here. Get below those levels and the bias would start to shift more to the downside here. On Friday's trade, we did try to dip below the 200-hour moving average, could not find momentum, and the price moved to the upside. So right now the buyers remain more in control, but we're watching that 52 level on the downside get below that level with momentum. Then we're looking for the 100-hour moving average. We could see something like this move down to the down into the upside off the 100-hour moving average. So be aware of that. Since we are so close to the 52 level, we could see a corrective move in the Asian session, for instance, and move back off that level. So be aware, but the buyers remain more in control here for the dollar versus Canada. The Aussie versus US dollar next. If we take a look at the weekly chart of this, we fell below a key swing level on the weekly chart. That level encompasses these lows through here near the 0.6252 level. Stay below that level, and the bias remains to the downside here for this currency pair. If we move back above it, we could see a rotation back to the upside here on the weekly chart. So watch the 62.52 level here for the Aussie versus US dollar on the weekly chart. If we go to the hourly chart and take a look at that, here, the 52 level is somewhere around this level right here where we had swing lows and swing highs. We can probably earmark, take a look at this swing area through here off the weekly chart and say that if we're able to get above that level and then get above the 100-hour moving average, that would start to open up the door to the upside. So 1 target, 2 targets, 3 targets, 4 targets here for the Aussie versus US dollar. You can imagine that the 200-hour moving average is coming to the downside here, and it would look to meet up with the high prices through here as the week goes by. So those would be the targets to get to and through on the top side. Until then, the sellers remain more in control here in the Aussie versus US dollar selling bias is definitely to the downside for this currency pair, with the low price for the year as our next key target at that level. Finally, let's take a look at the New Zealand versus US dollar. And if we take a look at that currency pair, we're getting close to the this 2020 low level near the 54.66 level. We moved down to 55.10. We are on this weekly chart below this swing low from this week and below the swing low from 2 weeks ago. Those levels come between 55.64 and 55.82. Keep those levels in mind. If we could move above those levels in the short term, we could see a rotation back to the upside. Here on the weekly or on the hourly chart, bias remains to the downside below the 100 and 200 hour moving averages in trading here today or this week. If we look at the range that we've seen in the short term here, this is where the price action has been centered and seen a lot of up and down movements. The 100 and 200 hour moving average are our bias and risk defining levels. We need to get above those to increase the bullish bias. If we get above those levels, we're going to start to look toward the 50% and getting outside of this red box. But until then, the bias remains to the downside. Look for short-term support somewhere around the 55.34. That was our low price here, and low prices through here, really the 34 to 43 level. If we went down to that level on Friday, but stalled before the close. If we go below those levels and we look for the lows here, and then we start to look toward the 2020 low further down below, but the bias in the New Zealand versus US dollar remains to the downside. So there you have it, ladies and gentlemen, a detailed look at all the major currency pairs as we head into the new trading week with bias defining levels, risk defining levels. I hope you've learned a lot from this video, and have a great week and a better trading week. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.